Yes, so when we think about the philosophy, we very much look at alpha, and alpha is unbiased. So we can generate alpha by holding companies that go up or being overweight them relative to the benchmark, or by not holding stocks that go down or being underweight them relative to the benchmark. It might sound very, very simple, but this very simple kind of philosophy kind of just has helped us significantly over the last few years, which have been characterized by Magnificent Seven stocks outperforming. And it would have been incredibly difficult for the fund overall to outperform without some exposure to those stocks. A nuance of that is trying to identify make or break stocks. So these are stocks that are both large and volatile. So think of companies like Tesla or Nvidia. These, as kind of the name suggests, can very much dominate the performance of the overall fund. And so we're very careful to monitor those particular stocks, and if required, be very nimble in our positioning to them, because it can be quite easy to be wrong-footed by some of those stocks, and that will impact performance. The fund has a very strong macro approach, which is unique. It is different, and we think this is frankly a gap in the market. I think many other fund managers, particularly in the UK, will say they're bottom up, focusing primarily on the stock specifics. But what we have found is that styles and factors have dominated stock market returns over the past few years. And what we do is that we vary our exposures to factors and styles. And we think that's an interesting way and a differentiated way to outperform. And it's not an approach for everyone, but it's worked very well for us. And in terms of the customers, it's given them sort of consistent outperformance over the last few years. And it's particularly valuable if you're kind of weary about the geopolitical uncertainty or macroeconomic uncertainty, which many clients will be. So this is an active fund. So obviously we're looking to outperform the benchmark. But on top of that, we're looking to deliver a positive sort of customer journey. So we're very much aware of the risk-adjusted performance of the fund, and also trying to be aware of any drawdowns relative to the benchmark and trying to limit those. So when we think about constructing the portfolio, what we do is we look at again the overall risk characteristics of the portfolio, the styles, the factors. And essentially we can add risk when we feel more convicted, and we can reduce risk when we feel less convicted. And an example of this would be in 2022, where we saw a very large macro event, and this is when the Fed decided that inflation was no longer transitory and it was slightly more persistent, and we entered a very rapid rate hiking cycle. And many of the growth stocks, particularly in the US, really struggled during that period. What we had done is that in 2021, we had taken profits in many of these growth stocks, so that when that drawdown came in the market, we were able to find and buy some of those stocks that had valuation dislocations. And so from our approach, that macro focus is very much differentiated and allows us to protect the customers when there are market drawdowns.